All right, we are live. Welcome back to another episode of Punch Card Investing, everyone. We're down to 3. We may have a potential 4th coming in shortly, but you'll just have to wait and see exactly who that's going to be. So that will be a little surprise for today. So thanks everyone for joining in. Today we're talking about share buybacks, or the cannibals, as maybe Monash Prabrai might call them. So this should be a fun one. I think we're all going to talk through sort of our own example of a company religiously buying back shares, or maybe more opportunistically buying back shares. So, Frank, do you want to kick us off?
Yeah, no problem. So I'm talking about Henry Singleton, which is someone I actually talked about when we did the capital allocators episode, I think. But he's famous for kind of starting the relentless buyback strategy. There was very little people back in the 70s or 80s when he was doing this that were buying back shares. It wasn't really a popular capital allocation decision, and it was criticized by not only his shareholders, but media and almost everyone else in the markets as well. So he kind of was the pioneer of all this. And from 1970 to 1984, he bought back 82% of all Teledyne's shares. And during that time, stock price went from $2 to $250. And then later on, he went to buy back in total 90% of all shares outstanding. He kind of went back and forth between his strategy. Early on during the late 60s and early 70s, he was actually raising capital. He was selling shares to acquire companies. He was doing like an acquisition strategy where he'd sell shares at about 20 to 30 times earnings and buy companies for about 10 times earnings. So an arbitrage situation he'd take advantage of there. And then during mid-70s through to late 80s, they started trading at around 10 to 15 times earnings roughly. And that's when he started his relentless buybacks, eventually getting 90% of all shares. I did mention in the previous episode that Warren Buffett and Charlie Munger kind of call Henry Singleton one of the best CEOs or capital allocators of all time. He's in the book Outsiders that highlights 8 of the best capital allocators or CEOs of all time. And pretty much what made him famous is these buybacks, and it led to huge returns for shareholders. So I'm just having a look at the numbers exactly. So from 1963 to 1990, the S&P returned 8%. Teledyne's competitors returned 11%, while Teledyne compounded at 20%. So a huge outperformance over the time period that he was CEO. $1 invested in the S&P during that time would return you 12, and $1 invested in Teledyne during that time would return you 180. So it was 180 bagger during the time, most of that coming from share buybacks. I will also credit, though, the acquisition strategy he was doing too, selling shares early on, which usually you think of as a big no-no as a value investor. You don't want to see dilution. But taking advantage of that, and he bought something like 300 or a ridiculous amount of companies during that time period when he was raising shares just to acquire companies, and increased their sales by about 500 times. During that same time period, earnings per share was only up about 60. So that kind of gives you a reference of how much dilution there was. But then from there on out, it was just complete buybacks and incredible returns for shareholders.
Wow, that's insane.
Yeah, it's a hard example to beat. I think it is the most shares ever bought back by a company. I'm not sure, Tom, maybe the one you're talking about might be close. But as far as I know, I think 90% of all shares outstanding is right up there with the most.
Yeah, it's really interesting because it's not just the buyback side of it. It's like sort of using your shares as a currency when they're overvalued as well, and when you've got a good opportunity to sort of use that. I think share buybacks in general catch a lot of flack. Like we see people sort of just buy back shares at any price sometimes, and often you'll see like compensation packages linked to earnings per share and stuff, which sort of incentivizes that behavior. But it's really interesting to see that sort of be made like actually really intelligent use of your shares as a currency.
Well, the main problem with share buybacks in the markets at the moment, and probably for the last 20 years, is usually tech companies that are using some kind of stock-based compensation that dilutes their shares, and then you just see a buyback to kind of even that out. But it's really a waste of money, because if they didn't pay out the compensation, then they wouldn't have to buy back shares. So there's just a waste of capital happening there. And that's why sometimes I guess people have a negative outlook towards buybacks. But if you do it at a low multiple and there was no other way to kind of allocate that capital, no better way to generate returns, then buybacks can be probably a better decision than a dividend in my mind. But it really depends on what multiple you're trading at.
100%.
And then I did have one other one as well. I'll give a modern example as well, because that's the 70s and 80s. It's kind of out of all our minds. It's not something that we ever got to witness. More recently, over the last 5 years, eBay is a company that has started to buy back shares. I kind of just saw, and I think that we talked about it a little bit on last week's episode, when Pat Dorsey had bought into eBay. It was kind of a little bit confusing to me why he'd do that, because it seems like a dying business. But over the past 5 years, it's been an 18% compounded return for shareholders of eBay, which really surprised me because revenues pretty much were flat. But a lot of it comes from their buybacks since around 2014, just before they spun off PayPal, which I think was 2015 or 16 maybe. And Seth Klarman, I think, might be the other person that got into eBay around that time. And yeah, they've been great returns, and they've bought back about 40% of their shares over the past 6 or so years.
Crazy.
Yeah, I'm just reading right now, Investing for Growth by Terry Smith. And Terry Smith owned eBay and held on to PayPal. It's actually the largest holding in Terry Smith's fund, but sold out of eBay. So I thought that was interesting.
Yeah, well, in all fairness, the PayPal spin-off done much better than the eBay shares, I think.
Yes.
Rather than 18%, the PayPal might have returned you 30 or 40%.
35 or yeah, it's crazy.
So it was a good decision by Terry. How about you guys? What do you guys got?
What do you got? What do you got for us, Brad?
First, could you just pop up the link I sent you in the private chat, Tom? I did a little work on company buybacks versus returns over the last 10 years recently. So I put a little table up on Twitter. So I took a quick peek while Tom's pulling that up at Berkshire Hathaway, because there's been a lot of talk about the buybacks recently at Berkshire. It looks like in Q2 of 2021, Berkshire spent around $6 billion. Q1, it was a little bit more, $6.6 billion. And then the last 2 quarters of 2020, it was $9 billion. So that's like, 21 billion, 22 billion over, just the last year, which is, pretty aggressive with buybacks. I think, Buffett took quite a bit of flack in the second quarter of 2020 when everything plummeted. But, I think in his defense, there's so much uncertainty in the system, right? And for how much insurance, Berkshire is exposed to, it's nice to have that war chest, not knowing what's going to happen. But I pulled up the history of, shares outstanding on Berkshire, and I was a little surprised. There was a jump in 2010. Not really any buybacks since 2004. That's how far ticker goes back. And then the buybacks really started in 2020. So Buffett historically has not been super aggressive with buybacks, but we've seen a lot more of that recently. I don't know if any of you guys have anything you want to add to that. Right. So there's the buyback champions that I did a little digging into. That was inspired by, Tom's video on NVR and just the story of NVR, which Tom is going to get into. But I got curious, what other companies have done incredibly well over the last decade, in part because they've been aggressive at buying back their stock. So,
can you zoom in on that at all, Tom?
I bet he can.
Because that's pretty interesting. There's a few of the
Think
companies
I can do anything.
We're testing Tom on the technology today. No,
We
Jack.
really are. Oh, look at this! Is beautiful.
No, okay.
Here we go.
Broke it. Oh god.
Boomer Tom.
Mate, my internet is struggling right now. All right, there we go.
So you see eBay there.
Is that any better?
Yep, Domino's Pizza is just crushing it.
I didn't realize that was something Domino's were doing. That's really cool.
Yeah.
I knew they'd compounded at a high rate, but I didn't know buybacks had any part of that.
You see NVR there, 24% CAGR over a decade, which is phenomenal. So I pulled that together last week. But any other thoughts on Berkshire from you guys?
I'm just kind of surprised that there wasn't as much buybacks over that 20-year time period. And I'm assuming maybe through the 90s, maybe Buffett was buying back more shares during that time period. I've kind of just been under the impression that he's bought back a reasonable amount of shares. As far as we know this year, he bought back a lot more than he has in the past 20 then, I guess we could say. Maybe 1% to 2% of the shares he bought back.
At least 17 years, it goes back to 2004.
Yeah, okay. No, that's just surprising in my mind. I've never really looked at Berkshire as a stock idea, really, so I haven't paid too much attention, but I would have assumed there would be at least more than that.
I wonder in the dot-com bubble if he wasn't buying back shares like crazy.
Yes, I don't know what price they were trading at during that period. I have no idea.
I mean, yeah, true. But Pabrai has mentioned, the day the NASDAQ peaked, Berkshire hit a multi-year low. So, you had people buying into pets.com, selling out of Berkshire. It's a very interesting dynamic. That doesn't mean Berkshire was low compared to kind of its intrinsic value, but be interesting to see through that time period what the buybacks were like.
Well, I know Buffett's been pretty public earlier on about buying back shares at less than, I think, 1 times book or 1.2 times book or something.
Okay.
So I don't know whether they were trading below that much over the past decade or two. Maybe they've been slightly above his range. Although I think more recently he kind of said that wasn't a rule he follows too closely anymore. But early on he was public about that.
Yeah. Well, I was actually under the impression that Berkshire was issuing shares in the 90s. I don't know if you guys have ever heard Chris Bloomstrand talk about that topic, but if you look at Buffett's track record as it kind of stood in the late 90s, I think he'd compounded at like 30% a year, more or less, by that time. And you kind of just had all these people like piling into his stock to the point where it was actually trading nowhere near that 1 times book value kind of threshold for buybacks. So it was trading at I think closer to 3 times book value. And you have to keep in mind that at the time, Berkshire pretty much, they had a few private businesses, but a lot higher proportion of their market cap or of their overall sort of equity was in stocks at the time rather than private businesses. So to have mainly just a stock holding when you're buying into Berkshire and have it trade at more than 1 times book seems a bit ridiculous. So when it was trading at 3, I think Buffett was actually issuing quite a lot of shares to buy private businesses.
Yeah, that would make sense. That's similar to that's what a good capital allocator would do. If they're trading expensive, that would be the only time they should sell shares. And they need to be trading below intrinsic value to get any value out of a buyback. So I'd assume Buffett is very disciplined about that. But yeah, I have no idea what kind of multiples they've traded at. There must be some time period that Berkshire were cheap and he was buying back shares, but I'm not too sure.
Last June was the cheapest in terms of price to book in the last 17 years. It's been up to 1.8 times book in the past.
Yeah.
So there you go.
Cool.
Yeah, how about you, Tom? What do you got for us?
Yeah, it must be my turn. Does anybody recognize this?
Yes. Value Investors Club.
Yeah. How about the specific write-up on Value Investors Club? Does
Can
this
you
bring
zoom
back
in
any
a little
memories?
bit? Can you show us your skills again?
Mate, I can zoom like you wouldn't believe. There you go.
Oh, wow. Look at that. Well, it's a winning write-up. I can see that.
Yep.
Charlie. Who do we know by the
Yes.
name of Charlie?
Charlie 479. That ring any bells?
Nope.
So if anyone doesn't know already, the username Charlie479 on the Value Investors Club is actually none other than Norbert Liu, who has a fund name which is somewhat similar to our live stream channel name that you're watching right now. So there's actually an old Joel Greenblatt lecture that I'd recommend you checking out if you haven't before. I think it's from around 2005, and that lecture basically just goes through 3 or 4 write-ups from Charlie479 on the Value Investors Club. And they are, I think, all with the exception of one was like a absolute home run stock. And Joel Greenblatt and Gotham ended up actually kind of seeding Norbert Liu's Punch Card Capital Fund and kind of helped him get started professionally. So pretty interesting that we can like still go back to write-ups that were done in 2001 and look at how Norbert Liu was kind of discussing a company like NVR. So
I love the font too. It's a unique font.
It is, yes.
Like it's on a typewriter or something.
Yeah.
The earlier write-ups on Value Investors Club, I think, might all be like that. There was a speculation of Monish Fabrai's username. So I went back and had a look at some of his write-ups, and they did come up in that font too. So I don't know if he's just trying to be different, but I know he nailed that one. He's done well. He's done well with that pick for sure.
Does he still have it? I didn't see it in his portfolio.
No, he's out of NVR now. So I'll sort of talk through, I guess, the story of NVR. It's been if NVR never bought back a share, it would have been a very successful investment. But share buybacks have sort of been like fuel on the fire for NVR. So I was a bit bored this morning, so I did some spreadsheeting. Hopefully, you guys can see that. Does that come through?
Yeah. Yep.
Mm-hmm.
Great. Okay, cool. So, for anyone that doesn't know already, NVR is a home builder, and home builders in many ways are sort of like land speculators in disguise. And NVR was a little bit of an exception to that. So rather than sort of outright buying a plot of land when they were building a house on it and sort of being at the whim of whatever the real estate market was doing at the time, they were in fact buying options on the land instead. So it was much more of sort of a capital light business, and also didn't get sort of hammered quite as hard in downturns and that sort of thing. So that's something that attracted Norbert Liu to the business, but buybacks were also a very big part of that. So I've pulled up some data here. So this is from 1995 through to 2020. In 1995, NVR had about 15 million shares outstanding, and they're down to like under 4 million shares now. So they're like the best example I think I've just about ever seen of a hardcore cannibal and just kind of constantly eating themselves and buying back shares. So I'll just walk through some of the numbers for NVR. So they've, like I say, bought back about kind of 3/4 of their shares. They've just kind of been buying back religiously. And I guess in terms of the power of actually growing like the underlying share price and earnings when that happens, this is kind of the effect that you get from a lot of share buybacks. So in blue is just sort of the absolute growth in net income for NVR. So it grew 52 times. I've sort of started both of these baselines just at 1 to see what sort of multiple they're getting on that earnings. But net income's gone up 50 times, but earnings per share have gone up over 200 times because of all the buybacks. Wow. So pretty crazy to just kind of see that visually as well.
Yeah.
The other thing I've added in here is just the PE ratio over time for NVR. So that also got approximately a double over this time period. So this sort of brings me back to reading Chris Mayer's 100 baggers, where he talks about the 2 things you need for a 100 bagger are a long runway of earnings growth, and ideally you want multiple expansion as well. So NVR has had both of those things, but it's also had the buybacks. So if you combine all of those things together between 1995 and 2020, this is what happened with NVR stock. So it went from about 10 to about 4,000, and as of 2021, it's even higher than this, I think. But crazy numbers. I think Norbert Liu was investing some of his mum's retirement account, quite a big percentage of his mum's retirement account into MVR in like 1994. So his mum did pretty well out of
his mum was happy with that.
Yeah, as you can probably see. And I just thought it'd be interesting to kind of break down, like, hopefully you can see that, how each of these things are actually contributing to like the overall returns from NVR. So you got about a 50x growth in net income. You got about a 4x in your sort of proportional ownership as the shares were being retired from buybacks. And you got near enough a double from multiple expansion as well. So 50 times 4 times 2 is a little over 400 with those numbers. So it was a 400 bagger over the time period we're looking at. 27% returns per year.
Wow.
Yeah, that's crazy.
Pretty insane.
That is a great example. So was part of Norbert Liu's thesis on that anything to do with these buybacks, or did he have something else that he liked about the business?
Well, he liked the underlying business in general. He liked that it wasn't as capital intensive and like sort of exposed to just the real estate market as a lot of the other home builders were, because they weren't having to deploy all this cash to like outright buy land parcels every time they wanted to build a home for a customer. So he liked that about the business. And then it was sort of just like, it was growing really fast and it was cheap. Like it was trading at 8 times earnings, and I don't know what the compounded earnings growth on some of those numbers are, but you know, from 1995 to 2005, so over 10 years, the net income went from like 1 to 50 kind of thing. So 50x in net income without any buybacks factored in, and trading at like 8 times earnings looks pretty attractive regardless of
that's pretty
whether
crazy.
they're buying back shares or not. So I thought that was a pretty cool story on the power of buybacks. I mean, if it was just the 50 times the 50 growth in net income and the 2x in multiple expansion, it's still a 100 bagger, but the buybacks turned it into a 400 bagger.
Yeah, I see here in the Value Investors Club write-up from Norbert, there is mention about buybacks, intelligent allocation of excess capital. So he was definitely paying attention to that.
Yeah, okay. I'm just looking at the shares outstanding on ticker as well since 2004. Looks like they kind of stopped around 2015 or slowed down at least, which makes sense with their multiple kind of being re-rated towards slightly more expensive, still probably pretty cheap. But yeah, that's pretty crazy. Even since 2004, they've bought back about 50% of their shares. So
I'm noticing in Dataroma didn't pick up Norbert until 2019. I don't know if that's because he was under 100 million AUM, but NVR shows up briefly in the Q1 of 2020, and then that's the only place it shows up. So I wonder when he sold the majority of his stake, if it was before, the housing crash in 2007, 2008, or what the situation was. And I wonder if he regrets selling, right? Because you look at that curve, it is a thing of beauty, that compound growth curve.
Well, he's not one to sell off easily, assuming he was investing the same type of way.
Too much activity, Norbert. Come on now.
I could only assume that he got at least 100 of those bags out of the 400.
Yeah. Well, I'm just trying to pull this up in the background, but there was a 2015 interview with Norbert Liu. He's very private, so interviews with him are rare, but that sort of walked through his full thesis for NVR amongst some other stocks as well, and I'm pretty sure it tells us when he sold it. So I'm going to see if I can track that down in the background.
It'd be interesting to see just in the whole curve where he got out. Yeah.
Okay. I'll share this again.
So
here's Norbert Liu's story with NVR. So began buying in his mother's retirement account, $23 a share in 1997. It doesn't say in here, but I'm pretty sure if you read the actual article, the full article here, I'm pretty sure he was adding to it continuously, even after it was up like 3 or 4x. He was kind of still buying it. But But yeah, sold some shares at 900, got out of it altogether at 700. So it's been a 5x or something since then.
Before the housing crash, look at that.
Yeah, sold a lot of it before the crash.
Good time to sell out of a home builder.
Yeah, it's interesting that it still showed up in 2020 because after reading this article, I thought he must have just been fully out of it by then. But
yeah, it looks like it was 3% of his portfolio in the first quarter of 2020, and that's the only place it shows up. So it looks like he dipped in and then dipped back out.
He could have bought back in after everything cleared up after the housing crisis. So that's a crazy one. That's definitely one of the better examples.
Yeah.
100%.
Cool.
Any others that you guys have on the top of your head, or we jump into some questions?
I'm interested, like with Brad's example, what Berkshire will do moving forward, because I think they're just, from sheer size, starting to run out of opportunities. Well, they've been slowly running out of opportunities for a long time because of their size, but buybacks is about all Buffett's been doing the last couple of quarters, right?
Yeah, there's really no other way they can allocate large amounts of capital. They're kind of limited with their investing opportunities, I guess. Well, with Buffett being so strict with the type of company he will buy into, at least anyway, there's only a select few, maybe 50 to 100 companies he can really choose from for a sizable bet. And he's always been against paying a dividend. So really, it's these small private business opportunities or buying back shares in large amounts. That's about all they can do with their excess capital.
And he needs enough predictability. Where is the company going to be in 10 years, which for technology companies, that's just normally been just too hard for him, with the exception of Apple.
Yeah. All right. Well, let's get to questions. If you've got questions, definitely pop them into the chat and we'll start getting through some of those. But this isn't a question, but this brings up a good, I think, recent story of yours that's probably worth sharing, Brad.
Let's hear it.
Is Brad in Turkey? What's been going on with Turkey, Brad?
Yeah, what's happening in Turkey? I've been shopping in Turkey. I bought myself a little something. So I put out a video yesterday on the one company that Monish Pabrai owns in Turkey. I finally figured out how to buy it. So opened a position in that. I'm excited about it. I'm a little nervous about it, but that's probably good. When you're buying a micro cap in Turkey, there's probably some intelligence to being a little nervous about it.
I'd certainly be nervous.
Which part makes you nervous?
Which part of it?
Yeah.
I think microcap in Turkey says enough about being.
Need I say more, Tom?
Yeah. Is it that I've tried to look up some filings. So it's racist logistics we're talking about here, isn't it?
Yeah.
So are there filings in English?
Yeah,
I feel like I've tried to look that up before.
On Twitter sent me a DM with a link to their filings in English, which is fantastic.
Oh, cool.
So I mean, we live in the information age. If you're looking for it, it's probably out there, but it's definitely tougher to find with companies like Races in Turkey. I'm reminded of Pabrai was talking to Guy Spear and trying to talk him into Racist a little bit. And Guy was like, I'm never investing $1 in Turkey. End of conversation.
Which, yeah, but the shameless cloners will do it. Of course.
I mean, I got to be as shameless as the next one, right?
There you go.
Or more.
Yeah. All right. What else have we got here? SC picked it up. He knew that it's.
He did. He said it. He said it before you did, Tom. So way to go, SC.
Here we go. Cool. I think if anyone wants to check out some other Value Investors Club usernames, you might have to do a bit of scrolling. But I put a tweet up on that maybe a month ago with a few different usernames for Pabrai and I think also Michael Burry. You can look at some old write-ups for him about combining of poultry producers and stuff. If anyone wants to dig into that.
Or hot tip with Twitter, you can just search. You can probably just search VIC investing with Tom or whatever your username is on Twitter to quickly find it. Search is pretty good.
There you go. Cool. Right. You guys seen any other questions you want to have a crack at?
There's a lot of Alibaba questions coming up as usual. We've tried to stay away from it a little bit. There was one from After Dinner Investor. Are all the hosts invested in Baba, and any concerns or still high conviction? Anyone want to jump on that first?
Take that first.
I can start.
Yeah,
I can start if you want. You go, Tom.
Yeah, I've done a few videos this week on some of my thoughts with Alibaba. So, I think we're all invested in Alibaba. I haven't made any major changes. I've actually been adding to it a little bit, which wasn't my initial intention, but it's gone down to a point where I feel comfortable kind of starting to add a little bit. So, I don't think there's been anything really major that's changed in the past couple of weeks in terms of like making my conviction or making my view on it more negative or anything. So I'm still comfortable with that holding. How about you guys?
Yeah, I'm pretty much the same conviction level I was always at. It's the rare position that I kind of bought into and continued to do a lot of research. I kind of wanted to, which I probably shouldn't have done since the share price kept going down. But the more I research, the more I'm aware of the different risks involved with it. Even just with my research on Tencent as well, and some of the different regulations and things put out by the government, and the crackdowns, particularly on the finance section of the business, the Ant Financial. There's a lot of concerns to have, and like I'd be lying if I wasn't saying that I'm concerned about them, but it's not to the point where I want to exit the position. The risk reward, in my opinion, is still very in favor of a lot of reward. But anyone investing into China should be very concerned with what the CCP does. My personal opinion is that Western media kind of overplay how risky it really is. And if you're going to read through any Twitter threads, it's usually the same thing. A lot of risk is pushed on what the CCP is doing. I kind of downplay that a lot, but still am concerned. It's not just something you can ignore. It's definitely a macro bet on anything you're investing in China. But usually on something like the US or Australia, I can ignore macro factors. I don't think you can do that with an Alibaba or a Tencent bet in my mind. So there's a lot of concerns, but not to the point where I'm not willing to hold the position. I think allocation is important. I wouldn't want to overweight towards China, and I'm like right on that limit at the moment. So yeah, that's about my concerns.
Mm-hmm.
Yeah, I mean, it's always challenging when you have, a sizable stake in a company and the price is just dropping like a rock, especially if it's the first time that's happened. But yeah, the story hasn't changed for me. But I do notice it's bringing up some discomfort, and like, the psychological aspect of investing can be really strong in times like this. So it's, I think, great to pay attention to that and learn more about how you're wired in that way as an investor, and hopefully learn from some of that. That's what I've been wrestling with.
Yeah, cool. The only other thing I'd add on Alibaba is like, and I mentioned this in a video earlier this week, but Alibaba are doing some fairly aggressive buybacks, actually, like we're talking about in this video. They issue a few shares as well, but they are, I think, sinking like $15 billion into buybacks over the next couple of years. So if you're a sort of continuing long-term holder of Alibaba, you're directly benefited by the share price going down in the short term.
Yeah, I think you just put out a video about that, right, Tom? So check that out, folks, if you're interested in learning more. Another thing with Alibaba that so considering the risks with Ant Financial in particular, I have a video I'm still editing at the moment, kind of getting through it all, but I finally kind of dug into Ant Financial really in my original valuations and things. I just ignored it and just accepted that there was some value there, but I didn't need to know how much because the core business was undervalued. But a lot of these regulations and crackdowns from the government really have hit Ant Financial. So one aspect of their business is credit lending between consumers as well as merchants as well. And that business was pretty much set to 10x over the next 5 years. It was the fastest growing aspect of the Ant Financial business. And that was almost completely ruined by the crackdown. They were then told they have to hold 30% of the money they were lending out. And they had all this access to data from Alipay with 1.2 billion users and everything else. So they kind of were in a perfect position. But to hold 30% of capital really limits how much they can lend out to consumers as well as small businesses. So that was a lot of growth that was going to come out of Ant Financial that pretty much cannot happen now. And they also switched from being a tech business to a finance business, which changes a lot of their taxes and everything else as well. So that was what really it really takes away from the value of Ant Financial in my mind, which again, you don't need to be too concerned about, as the core business is probably undervalued as well. But if those types of things start happening to e-commerce, then that would be a good time to get out of Alibaba in my mind.
Yeah, I like the last part you said there. Like the core business is probably undervalued as well. So like at a certain price, some of these things just don't matter, right?
Yeah.
You know, the odds are still good. Got one for you here, Brad. Recently, there was a tweet about a company CEO choosing between buybacks and closing debt with EV to free cash flow ratio. Buffett uses price to book. Are there any criteria you think about for buybacks?
So deciding between buying back and paying off debt.
Yeah, I guess it might be more of like a valuation focused question. Like if Buffett uses this price to book threshold of 1.3. If it's below that, maybe he's better buying back shares. If it's above that, maybe he's better paying down debt or doing something else, paying dividends, maybe.
Yeah, I would think it'd be
thoughts on
fairly nuanced to the business, right? I would think.
Yeah, it really completely depends.
Yeah.
I think in most circumstances, assuming that they're trading below intrinsic value, I think using multiples is probably a poor way to go about it, even though Buffett does do that. Mm-hmm. Each business, there is a better multiple to kind of use, I guess. But as long as they're trading below intrinsic value, however, you need to calculate that for the business. I would say buying back shares would be the better option than paying down debt. But if they're on the more expensive side and there's no other way to reinvest that capital to do something else, then there's no problem in paying down debt as well. That's a good sign. But like we said, every business uses debt in different ways, so it just depends on the business itself.
Yeah. I think, like you say, Buffett uses a metric, and there's a million different metrics you can use, but I guess price to intrinsic value at the end of the day is the key factor, however that looks for different companies.
Yeah, there's all kinds of proxies, and they change over time what the best one is, right? Buffett has kind of stopped using price to book as a proxy for that, it sounds like.
Yeah, for sure. And I think it also depends on the debt. Like if you've got Buffett's 0% bonds in Europe, like he's probably not in a rush to pay that off. And whereas if you've got if you're some commodity business or something that has a lot of debt and you don't know what your earnings are going to be next year because commodity prices are changing so fast, that's probably a situation where buybacks might not be the best idea.
Pay off the debt, yeah, for sure.
Yeah. The most important thing is to not go bankrupt. After that, we can decide on some other stuff later.
It's rule number one through the business lens, right?
Exactly. Yeah. Sure.
I have a question for you guys. So have you ever seen a single company that's gotten so much super investor attention as Alibaba has recently? So many super investors buying in at once. Does any other company come to mind?
Valiant.
Don't say that one.
That's actually like that's what happened, though, right? There was a bunch of super investors in that, I'm pretty sure.
Yeah, I don't know.
One that jumps to my mind.
Holdings.
Oh boy.
Not as much as Alibaba, but over time, Facebook has been a popular one. There's been a lot of super investors and smaller fund managers that have been in and out of that one. I think 2018, there was a period where it got fairly cheap and it was very popular. But I probably haven't seen anything to the extent of Alibaba at the moment. The media does push that narrative a little bit as well. Like it's the focus of media and FinTwit and everything else right now. So it's hard to know. Maybe there was things earlier on before I was even into investing, but Baba is definitely, between the investors that I care about, certainly, Baba's by far the most popular.
Right. Yeah, Facebook, obviously it's very popular with super investors. I kind of saw it a little bit more staggered, a little bit more spread out in terms of when investors were getting in. With Baba, it's like across the board. It's just insane. And what's crazy about it is you've got these US-based investors who are all buying, right, this Chinese tech company. So it's a very interesting dynamic. I wonder if that's ever happened where there's been so much focus from super investors in the US on a company outside of the US. Just thoughts. Curiosities.
Yeah, I haven't got a lot that come to mind, to be honest.
Yeah.
All right, what else have we got here?
Oh, I like this. Here you go.
Anyone buying Tencent as Tencent Process or Naspers?
They gave a shot at me there. Seems Frank gave up on Naspers discount. I don't know what that really means. I bought into Tencent and Process personally, so I did leave out Naspers for that. I think of the 3 ways to access Tencent, which in my mind is what I'm betting on. I think Naspers has the most confusion around the structure and what's going to happen with the tax and making up such a large part of the Johannesburg index and everything else. I think although it's the most discounted, I'm not relying on the discount to close at all. So I didn't have as much of an interest in Naspers. And that's not to say that isn't the best way to play it. Maybe they'll make some good capital allocation decision that will make that the best way to access it. But I like Process because they have a VC portfolio that comes for free, essentially. They also have the discount that may close and offer a bit of a return, but you don't need to rely on that. Process just has 85% roughly of their business in Tencent, and then the VC portfolio that comes for free. And then Tencent, I've talked a lot about on my channel before, but I think that's cheap. Pretty much their portfolio almost comes for free as well, which is one of the biggest portfolios in the world. Of the 3, I just thought Process and Tencent were hard to choose from, so I kind of split that bet. Think of it as kind of one holding, but I split it into a 5% position each.
Nice. Yeah, I bought into Process. It's not a big stake. It's just kind of prompting me to do a little bit more work. But yeah, it seemed to me, there's a lot of people talking about how attractive the discount is with Naspers, and it's not as big with Process, but it does seem to me that there's more kind of value unlocking opportunities with Process versus Naspers. And being domiciled in Amsterdam, I think there are a lot of advantages to that as well.
Cool.
I wanted to pull one up.
Yeah,
Tom, unless you wanted to add something.
Sure. Yeah, I was just going to say I'm not in either Naspers or Process. I've sort of been immersed in the Alibaba world, so I haven't even looked at it, to tell you the truth. I don't think I wasn't on the stream when you guys were talking about that, so I never prepared anything to talk about. Yeah, I think I'm getting to the point where I'm probably maxing out like my China exposure threshold just with Alibaba. So yeah, Alibaba's tricky enough and time consuming enough to understand, so I wouldn't want to throw Naspers and Process and Tencent and all that into the mix as well to try and keep up with personally.
Sure. Can you pull up this question from Bradley Hope. Question: are the best investors able to detach emotions completely? I thought that one was interesting. Yeah. Yeah, in what is that book, Richer, Wiser, Happier by William Green? He alludes to this throughout the book, that these incredible investors are often wired quite differently than most people, and I think part of that shows up here, where they're able to detach from their emotions, and as Charlie has said, like a head, his body is just to carry his head around, and he's just reading all the time, right? There's some kind of detachment from what a lot of the rest of us experience in the world. So I think that's probably a benefit in investing. Psychotic might be a strong term. But yeah, I don't know. I haven't heard Monish Pabrai really talk too much about, well, he's talked a little bit about his experience in the crash, where his portfolio lost I think it was 70% in the great financial crisis. And he said his wife didn't know there was anything going on. Like, he didn't act any differently, even though on paper his net worth had dropped dramatically. So, I think there is some different wiring for some of these great investors. I don't know. What do you guys think?
Tom, you got something there?
Yeah, my internet's chopping out a lot, so I caught most of that. Apologies if I'm breaking up at all.
It's all good.
Yeah, I think both Munger and Pabrai are quite big fans of the Stoics, and I think they try and take that on board as much as they can. So I think that is talked about a little bit in Richer, Wiser, Happier, that they kind of try to employ a lot of Stoic philosophies, and it's not so much like worth spending time on why these things happen to you. It's more about you should focus on how you react to these adverse circumstances, or even if it's something like your portfolio dropping, or someone like Charlie Munger losing an eye, even and he just kind of soldiered on through. There's, I think in some ways they're sort of wired like that, and I think with others it's sort of more of a learnt behavior over time. I actually just finished up that book this morning, and it talks in the last chapter a little bit about Bill Miller. I think Bill Miller was down 55%, I think, in one fund and 60% in another fund. And his assets under management were enormous beforehand. I think it was $70 billion he was managing. And post financial crisis, he was managing 800 million, because one, the portfolio had gone down a lot, but two, he'd had a ridiculous number of redemptions, because his portfolio was just filled with the financial stocks, many of which just blew up. He was in Bear Stearns and a bunch of others. So, but Bill Miller's I grew up more or less in poverty from a financial perspective. So, what is it to me? If I'm only looking after $800 million now, and at the same time, he was comfortable enough to absolutely load up the truck on Amazon. And I think he's, it says in the book, he's the largest shareholder of Amazon that's never had the last name Bezos. So he's doing okay. And he just seems to just be completely unfazed by losing money.
Wow.
I think you kind of need to be, if you're a long-term value investor, I think that's, if it's not the mindset you have, then maybe you need to think about doing something different. Because if you do get kind of caught up in hype or news or a stock market crash or anything else, there's a good chance you can lose a lot of money. So I think you kind of need that mindset where you're willing to be down, you're willing to see volatility in your portfolio. I know we're all fairly concentrated investors, so we're willing to have that volatility. Most of my portfolio is in one position. It's been down, I don't know, it's down 10, 20% or so, which means my portfolio is pretty much down the same amount. But I don't even look at it. I don't even check my portfolio. Very rarely, usually only to make a YouTube video about it. So
we're a bad influence on you, Frank.
I kind of just, you need to kind of have that mindset to buy and just leave it for a very long time. Of course, you have to keep up to date with the company and what they're doing, but you really need to be reluctant at selling. I think it's a skill you can develop over time that you can get better at as well, but partly it's a psychological trait as well. I think most value investors, though, probably have that trait somewhat, at least anyway. Otherwise, they'd probably be doing something different. So hopefully everyone listening kind of thinks the same way.
Yeah, and you've got to understand the rules of the game, right? You've got to understand, okay, what this is worth is based on what the business is doing, not what's happening with the price, what's happening with the market. A lot of people just, they don't have that frame, and it's obviously a huge advantage.
Yeah, and I think it is something you can learn over time. Like March last year, I owned a bunch of Graph Tech, which I think peak to trough was down 50% or maybe more, and it's, come back from that. And that was a little scary at the time, to be honest, but now it's like, now I feel completely fine. Like when as I've been adding to Alibaba, like I had some cash waiting because I'm constantly converting New Zealand dollars to US dollars to, buy stocks because I earn money in New Zealand dollars, right? And that process usually takes a day. And I was like planning to add to my Alibaba position, and the price went up like, I don't know, I think it was that day it ripped like 9% on the Hong Kong exchange just this week. And that like pissed me off. Like I'm mad that my stocks are going up because I'm trying to buy it. So I'm glad to be developing that kind of mindset
That's
around
awesome.
these things.
Yeah.
And one thing I kind of do as well to kind of help myself be that way, I guess, is think about the dollar amount I have invested. I could lose 70%, I think, of my portfolio and still be break even with the amount of money I've invested. So if I wasn't investing, if I never found Buffett or anything else that kind of directed me towards this style of investing, I would have just had that as cash anyway, or wasted that money and even not had it at all. So if you can kind of think about it that way and just have that attitude that if you're down 70%, you still break even. Of course, that's not true depending on how long you've been investing.
You got to have some early wins for that, right, Frank?
Well, the longer you've been investing, though, if you've been investing for 5 to 10 years, then realistically, you could lose half your portfolio and you should be up from your original cost of capital.
Yep. So you're telling me I just need to find 100 bagger and then I'm good for all losses the rest of eternity. What was the other? Just the last thing on that particular discussion I was going to say is there are some sort of structural things you can put in place to kind of stop yourself from getting too overly emotional. Like most of the people we follow are always talking about like don't invest on margin. Like if you have that in place, that's naturally going to make you a lot more nervous than if you were just investing cash that you had sitting around one day. So like not using margin, not shorting, not getting overly involved in having a bunch of like call options and all sorts of stuff like that. I think those are some structural things you can put in place. And also, just basic stuff like having emergency funds set aside, if you're trying to like for me, for example, I'm trying to buy my first home at the moment. So the last thing I'm going to do is have like my first home deposit invested in stocks right now because I can't handle that volatility. Like I need that cash fairly soon. So if you put some of those things in place as well, I think it can help quite a bit.
Yeah, I wanted to pull this one here, the Uber Cannibals in the free lunch portfolio from Pabrai. The latest ones, it looks like they're like insurance companies and financial services companies. So I'm not particularly comfortable with those kinds of businesses. Those aren't, I don't understand them. But that's, I guess, since Pabrai ended up buying an insurance company, realizing it wasn't going to work, and then sold it. Who did he sell it to again? Do you guys remember? It's another big investor.
Francis Chow.
Francis Chow. Yep.
Francis Chow.
Yep. So maybe he's pretty comfortable with insurance companies. But it was interesting. Like, I wonder if he just has, like, how does he select the Uber Cannibals for the free lunch portfolio? I don't think he really goes into his methodology for that. Maybe it's just, what's in his wheelhouse in terms of industries and kind of cherry picking that way. What are you trying to pull up here, Tom? There it is. Uber Cannibals.
There you go.
I haven't followed this too closely. I think I watched one of your videos. It might have been Brad, talking about how he kind of changed the strategy he was using for this freelance portfolio, which I really don't like. And kind of for that reason, I haven't paid too much attention to it. It seems it's like he's trying to push a quantitative no-brainer type, just do this and you'll make money. But then he's very selective about the stocks he chooses at the same time. So
I think the no-brainer wasn't working. I mean, it was just a couple of years, right? I think he started this in like 2017, but it was underperforming the index. And so I think he felt like he could make some tweaks and maybe juice the returns. I don't know. What's your sense, Tom? Do you have any take on that?
Well, yeah, it'd be good to... I don't know if we get any like mechanical rules on this stuff and how Probry's approaching it. Probably because there are none. Like if we look at the shameless cloning, there's a fair bit of Probry's portfolio in three of those names.
Absolutely.
And actually, now that I say that, he owns Google, I think, in the Dakshana portfolio he's mentioned before. So that just leaves Chipotle. I don't know. I actually did take a look at some of those Uber Cannibals a few weeks back. And by take a look, I mean, I like Googled them to see what they do and said, it's insurance. That's too hard. So I don't know that I've ever gotten a lot out of those, to be fair.
Yeah. What else do we have for questions? Frank, you're getting poked a little bit in here in the comments.
This is a good one.
He said another thing about KPG as well.
Yeah.
But yeah, really, a lot of my net worth is in that position. So it's easy to say that now while it's up a lot, but it'd have to go down fairly dramatically for me to be down money on that one. So it does help you feel comfortable. And I guess over time, everyone will have a stock like that in their portfolio that is carrying the returns and is up a significant amount. So once you have that, I guess that's a good kind of fallback that you can just know that at least that done well, I'll be okay if I lose a lot of money.
Mm-hmm. Cool. Are there any other questions you guys seen in the chat that you want to have a crack at?
Yeah, there was one about super investors in Tencent or Naspers. And I thought recently I looked up the over-the-counter ticker for Tencent in Dataroma, and I thought there was one, but now there's not. So I know there's a guy in South Africa, Jean-Pierre Verster. He's on Twitter. He does interviews once in a while. He's bullish on Prosus. I think he owns Naspers as well, and also SoftBank as a way to own Alibaba. So he might be a guy to look into.
Interesting. I know. I don't think he manages enough money to file a 13F, but Matt Peterson, I'm pretty sure, is in Naspers.
Yeah.
So if anyone's ever done any digging into the Daily Journal Corporation, you've probably found Matt Peterson's write-up. So he's very concentrated. I think he's got he's in Berkshire, Naspers, Seritage, and a couple of others I'm forgetting. But
he owns one of Probry's private funds or something.
Yeah.
I don't remember what the structure is for that, but yeah, I think he manages around 10 million. So not into 13F territory yet.
Yeah, he's had great returns though.
19% for the last 10 years. Yeah, pretty good.
Yeah.
Also, for Tencent shareholders, or some of them are in process, there's two guys I've been kind of talking back and forth with on Twitter. They're not super investors by any stretch, but Jordan Nell is one person who's got some really great write-ups about a lot of different companies, but there's a huge Tencent write-up that goes into a lot of detail that I highly recommend checking out. And I'm sure if you're that interested, you could probably reach out to him on Twitter as well. And there's another user, Panda Value, I think is his username. He owns Process, as far as I can remember. He's another one that's open to going back and forth on any ideas you have about that. So that's the great thing about Twitter, I guess, and some of these smaller private investors or smaller fund managers, is that unlike Monish Pabrai, where he buys something, he's not putting up write-ups about these companies he's buying into, like in-depth research, whereas some of these smaller guys do. So it's great to have access to things like that if you are interested.
Yeah, unless it's racist or that one that you were talking about, Tom, GraphTech, where Pabrai kind of refers to those in every Q&A. At least he did with GraphTech for a while. Hopefully, racist doesn't turn out the same way that GraphTech did before Pabrai sold out. But
yeah, I've made some money in GraphTech, so apologies for that, Brad. But,
that's okay. I forgive you. I got you back. I got you back with Micron, so we'll just we'll trade.
Okay, there you go. This is an interesting one. So, like most value investors talk about not looking at your portfolio, staying away from checking price of a stock daily. Don't you think running a YouTube channel about investing, I think he might be trying to say, is a contradiction or is contradictory, I think controversial. Thoughts on this? Long-term investing, and then, Brad, you're throwing out daily uploads on YouTube. What's happening there?
Right. Well, I haven't been lately, but yeah, there is something I find tricky about that. I've been trying to focus more and more on content that's around, learning how to be a better investor rather than just pushing, hey, I think this stock is the next 10 bagger. You know what I mean? And I think that helps me learn the material, by having to teach it and then getting feedback from everyone. So if I'm doing that kind of stuff, I think it's beneficial. But yeah, it's easy to slip into talking about specific companies. I mean, that stuff tends to get more views and things like that. So it's tricky. It's tricky. What do you guys think?
I'm starting more and more to try and put out content around what I'm currently researching. So I've been doing a lot more Tencent and Process videos lately. I had a lot of Alibaba things in the past, and it helps me kind of stay up to date with looking into the companies that I own. So as long as the audience is somewhat attracted towards that, then I can keep kind of just pushing that out on YouTube, as well as it's forcing me to do the research as well. I try not to just pick a hot topic. I have in the past, but just something that's in the news that I know will get a lot of clicks. Alibaba being the odd example there where it gets clicks, but it's also where I'm spending most of my time researching. So I'm happy to do that, I guess. So I don't know. I find it kind of helpful in a way to kind of force me to research ideas maybe in more depth than I would have. Being able to describe them is a great way to learn about it as well.
Yeah, I agree. I'm definitely a better investor because of the YouTube channel. Like it forces you to think through ideas that you might not have fully thought through otherwise, I would say, when you try to explain it to a camera. So, but yeah, it's a bit of a balancing act. Like I think all three of us we're uploading videos frequently, but would hope that the ideas and concepts and everything in there are fairly timeless. We're not sort of trying to predict what stocks are going to do next week or anything crazy like that. So
there's a comment I just wanted to touch on quickly from Bruce C. Says James and Frank. I don't know who James is. Connor Haley said thesis is intact for VQS. That's a Canadian microcap that I sold out of fairly recently. I'm purposely being cryptic about why I sold that stock. I actually just needed access to capital that I couldn't take from my personal account. That'll make more sense one day, but I wasn't selling that because I didn't believe in the company so much. It's right at the top of my list right now. I'm back into researching that as much as I can. There's a good chance I could buy that again in the future. But at the time, I just had to sell something, and it was at the bottom of my portfolio of conviction at the time. So, yeah, I haven't seen Connor Haley's comments about it yet. That's how I originally found the idea, is he put some research out around it. So I'll have to check that out.
What did it do while you hold it, Frank? If you don't mind me asking, I have no idea what it's done.
It was why I held it. It was pretty much a break even, and I think it's about the same.
Okay.
I would have to check. I haven't looked in the past month, maybe, but pretty much it's gone nowhere over the past 3 to 4 months at least.
Cool.
Here's an interesting one. This is one people probably have. I feel like with a lot of these questions, people kind of might know what we're going to say if they've watched a lot of our content and stuff before. But here's an interesting one. What don't the people know about you guys?
I don't think my non-investing job. I don't know if I've made that public before. Maybe on here, but I'm a teacher.
It doesn't have to be a job. You can tell us what you do for a hobby or something.
What do you teach, Frank?
So high school business teacher. So kind of
day trading.
kind of along the same lines of what I'm doing, but it's a very low level accounting type things that you teach in business studies here in Australia. A couple of management things, nothing too exciting. But we get 2 weeks a year where we get to focus purely on investing. So that's the best 2 weeks of the year.
Nice. What do you do for fun besides checking on KPG? Making YouTube videos.
My main hobby outside of investing is probably chess or jiu-jitsu. Jiu-jitsu is like a martial arts for people that don't know.
Yeah.
And then a lot of chess. If I have nothing to do, I just pick up my phone and play on chess.com. Not very good, but I like doing it.
There you go. I did not know that. I knew you were into martial arts of some sort, but I had never heard the chess one.
Yeah, that's new over the past maybe year or so, maybe a little bit less.
Yeah.
But I've always kind of liked it, but just got a little bit more into it recently.
Yeah. Nice.
How about you guys, Brad?
Yeah, so I do. So before I got into this whole investing thing, I was like a hippie, basically. So I was into like sustainability and natural building and, animal husbandry and all that stuff. So I still do some sustainable landscaping kind of as my job outside of, making content and researching investing. Which is great. Get my hands in the ground. It's very not being in front of a computer, which is helpful to have that balance. Yeah. Which is similar to kind of the field that you're in, right, Tom?
Yeah, I'm in the agricultural industry, but I am.
Tom's a hippie as well.
But you are in front of the computer all day.
Yeah, I'm the absolute probably opposite of an agricultural hippie, though. I'm far more conventional farm system sort of. But New Zealand's very different sort of farming styles to the US. Like we don't have big barns full of animals or anything like that.
Right.
But yeah, I work for a farm software business basically. So do a whole range of things, including running various training courses for farmers and farm business advisors and that sort of thing. So that keeps me busy in my day job. And then outside of that, YouTube channel keeps me pretty busy. Also trained for powerlifting and strongman. You can probably tell because in every second video I'm wearing some sort of like Waikato's strongman or powerlifting like t-shirt. So I think people might have picked that up by now. And I'm in lockdown at the moment, so I've been trying to find other things to keep me busy. I've picked up the guitar a little more. I play the guitar a little bit, but I'm not that good.
I play guitar as well, actually.
Oh, there you go. Cool. So I've been trying to teach my girlfriend how to play guitar like in lockdown, which has been entertaining.
We'll have to do a live music session one day. Do you have an instrument, Brad? What do you play?
I play the harmonica.
There we go.
So
do you really?
I'm about as good as my 2-year-old, but it's okay.
Well, if we're all awful, then it'll be fun.
Yeah, Tom, it'd be awesome to show a clip of one of your strongman competitions at some point on the live stream here. And Frank, your jiu-jitsu, we can get that going. That'd be fun to see.
Yeah, for sure. And you could, I don't know,
out in the garden.
I'll be out in the garden. Sure.
There you go. Well, maybe if I don't know how many likes do these streams typically get? If we set some egregious thumbs up goal that we hit, then we could have a jam session and get some gardening tips from Brad. I don't know.
That sounds great.
How many likes, Tom? I'm putting the pressure on.
I don't know.
It'd have to be like 1,000 or something, I think.
I don't know. Does anyone want to pull up what we typically get? I'll bring this up very quickly. My internet's horrifically slow, so this might take a while.
Uh-huh.
Well, our typical views is around 1,000 to 2,000.
Okay.
So I'd guess we only get about 100 likes. Maybe would be a good video.
Yeah, I think that's right.
Okay. Should we aim for 250? If we get 250, we'll.
Oh, that's
we'll have
low.
a jam
That's,
session.
That's too low. We got
That's
to
low?
be more aggressive here, Tom.
500.
Oh.
500.
I really want to put on a
500
show.
sounds
I
good.
don't know about you guys. 500.
500, yeah.
And what do we have to do? We have to show our hidden talents.
That's right.
How about 500? How about 500? But we all have to shout it out in our next upload on our respective channels to give it a shot at hitting 500.
Oh.
Yeah, righto.
Or then do we up it to like 750 if we're going to do that?
Someone just wrote a comment. How many likes to not do it?
Well, we could include both
if
thumbs
we get
up
100
and
dislikes,
thumbs down. Any engagement, we're counting.
Okay.
Yeah.
So should we lock that in? Should we lock in 500? But
let's lock it in.
Give
Yeah.
it a shout out.
Yep.
500
We'll
likes.
give it a shout out on our next upload.
Hidden talents. So Jack and Kran are going to walk into this and have to figure something out. And I hope they have something.
Yep.
Okay, cool. All right. Any last questions you guys are seeing, or should we wrap it up there?
I think we should all start playing bridge. That's probably a good idea. I think it'll help our investing.
Mm-hmm. Definitely. I believe there's a local bridge club actually in my city, but I reckon I'd be the youngest person there by about 60 years if I went along to a local bridge club. But
well, you know what?
Munger
and Buffett used to only hang out with really old people when they were young, so that might be a good strategy for you, Tom.
Were those guys ever young? I feel like they've been old for a long
time. No, they've always been old. It was just the
they came
facade.
out of the womb old.
Yeah.
Yeah.
Cool.
Okay, cool. All right, good place to wrap it up, I think. Thanks everyone for joining. We will see you again next week, but definitely give us a thumbs up and hit subscribe if you haven't already. If we hit that 500 like target, you will see all of our hidden, probably not that good of talents, mediocre talents, I don't know. But thanks everyone for tuning in, and we will see you next week. Thanks, guys.